You talk about China backing the yuan with gold. You're talking about Russia ultimately backing the ruble with gold. But gold in itself, physical gold, is fungible. It's the only fungible asset on this planet Earth where you can actually pin it down to an exact exchange price based upon supply demand. So if you've got supply demand prices being developed in between Russia and China, for example, and those BRICS nations that interact with that, how can you have a separate price in the West? Because if that is underpriced and you want the supply, then you're just going to go to the West and take everything on offer, take everything that's unallocated and then alchemize it.
Something big is happening beneath the surface of the gold market. And unless you're paying close attention, you'll miss the real story. Russia is building its gold trading platform, set to launch by the end of 2025 on the St. Petersburg exchange. It's not just a market tweak. It's a full-scale breakaway from the London price fix, the system that has dominated global gold pricing for decades. This is a shot across the bow of the Western financial architecture. Here's the thing. China and Russia aren't making noise about this. They're accumulating gold quietly, while Western institutions continue to offload their holdings. Sanctions on Russian gold? Irrelevant in this context. China doesn't recognize them, and the two are settling trades in their currencies outside the reach of SWIFT and Western oversight. Andrew Maguire, a veteran insider in the gold space, says it plainly: this is the real gold market now, not the leveraged, derivative-heavy circus that is COMEX or the LBMA. As China and Russia begin pricing and settling physical gold between themselves, that price becomes the functional market price. It's gold without the paper fiction. Let's put numbers to this. Russia produces around 300 tons of gold each year, trailing only China. However, it accounts for only 2.37% of the global supply. The rest? It stays home stockpiled. That's not inefficiency, it's strategy. These are reserves being used to insulate against dollar risk and future-proof their financial systems. And here's where things get more serious. According to the World Gold Council, institutions, including central banks, are increasingly bypassing traditional Western exchanges altogether. They're cutting direct deals with miners. Maguire doesn't mince words. The old pricing mechanism is dying. The BRICS are building a parallel system, one that values tangible assets over leverage, settlement over speculation. The West still plays by 20th century rules. Meanwhile, the rest of the world is flipping the table. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
The amazing thing that I find I'm gobsmacked, to be honest, is that how the mainstream media and I mean very few people have picked up on the fact some good stuff, some major stuff went down at that BRICS Rio summit, and it was really, I mean, if one was going to sort of summarize it. And obviously it's difficult to do that, but it is the tokenization and the financialization of real world assets. And between the BRICS nations, they have literally, if you add in the energy complex, grain complex, all the different commodity complexes that they touch themselves, so trillions of real world assets are potentially going to be digitized and really put into the gold backing. Basically, the way I look at it, you were looking at a 7-step settlement process outside of the SWIFT. I think it's so major, and I just cannot believe that nobody is focused on it. All they've focused on is Trump's threats to tariff the hell out of these guys. When how the hell you can tariff? I mean, this multipolar majority control the bulk of all commodity assets that they either consume or produce amongst themselves. So why the hell should you use a dollar trade when you're actually when you've got these different nations trading amongst each other? It's amazing, and I think as liquidity and obviously as physical market liquidity flows into the West End, we have some really good connections. Our liquidity providers are very face China, face Russia, and obviously some of that stuff is not official because obviously there's sanctions against Russia. But I'm not saying our liquidity providers, but we are in contact with liquidity providers who are reliable. And I think what it is that we're seeing as this liquidity pours into China, and as you say, they're opening up vaults all around the world. Well, it's due to the very fungible nature of gold. So if you have gold vaulted in global vaults all over the world, and you have a transaction, it can be T+0 settled by simply moving it across from one vault or to the other side of the vault into that other nation's area. And of course, then it's globally fungible. So it doesn't have to move at some point. It doesn't actually have to move at all. So, because then say if it's in Singapore and it's against Brazil, then, why would you need to start shipping stuff around when it's a high quality, first tier, high quality liquid asset? It's a first tier asset. So it's cash, it's money. So yeah. And as much as Russian gold is sanctioned, it's sanctioned into the Western facing markets, not sanctioned into essentially into China, for example. And you talk about China backing the yuan with gold. You're talking about Russia ultimately backing the ruble with gold. But gold in itself, physical gold, is fungible. It's the only fungible asset on this planet Earth where you can actually pin it down to an exact exchange price based upon supply demand. So if you've got supply demand prices being developed in between Russia and China, for example, and those BRICS nations that interact with that, how can you have a separate price in the West? Because if that is underpriced and you want the supply, then you're just going to go to the West and take everything on offer, take everything that's unallocated, and then alchemize it. How little trust there is in the, let's just say, the LBMA CME ring-fenced marketplace, and I think what's happened is because there's so little trust, even the World Gold Council came out and did a survey of, I think 36 central banks came out and said, yeah, we're buying gold directly from artisanals, we're not going through London anymore. So it's interesting. So that, if you've got, if the price isn't really being settled in at the AM and the PM fixes in London, or the silver fix at noon, if it's not being settled there, then where is it being settled? And the thing is, what's the real price? And I think people are saying, well, I don't trust any of that stuff. So basically, I'm just doing deals direct. I'll take ownership stakes. I'll just literally make agreements. And I think the LBMA, CME are losing control to be able to actually set a price, an FX price.
For years, the COMEX and LBMA futures markets have dictated the global price of silver, but that grip is slipping. The spread between the paper price and what buyers are paying for physical metal is now too vast to ignore. It's not just a pricing anomaly, it's a signal. The old system is losing relevance, and the physical market is beginning to dictate terms. Andrew Maguire puts it bluntly, the cartel has lost control. COMEX and the LBMA can still push prices around during options expiry, but the trendline doesn't lie. Physical demand is now leading price discovery, and as long as London silver inventories keep trending lower, while industrial and investor appetite holds steady or grows, that pressure only builds. Take COMEX data. In just 3 trading days, 1.3 million ounces flowed into the vaults. However, here's the important part. The registered category, which holds metal that's available for delivery, has increased by 3% month to date. It now sits at 196.5 million ounces. That's not just restocking, it's preparation. Registered silver doesn't sit idly. When it moves like this, it reflects one thing: future delivery expectations. Someone, likely institutional buyers, ETF issuers, or large-scale industrial users, is lining up to take the metal. Not paper, not leverage, not contracts. Real bars, real silver. If this trend holds, declining inventories, rising delivery demand, and continued stress on global supply then the entire pricing regime could flip. Instead of futures dictating the spot price, we'll see the spot price drag the futures market behind it. That's how real price discovery works. Maguire says it best. The paper games are fading. The cartel is losing its edge. And the physical silver market, slow, steady, relentless, is taking over. Let's get back to the interview.
You know, what's interesting, you must have mentioned silver. We got a lot of silver subscribers. And you mentioned silver. And certainly, I think one of the things, shortages. You talked about shortages. And there's so much evidence of that. It really is. It's about valuing silver based upon a true physical supply, demand, price, and marketplace. And yes, obviously, and I fully concur with you. There's times, why wouldn't you go and attack the COMEX paper positions? Why wouldn't you, knowing very, very well that there are a lot of speculators in there, and you can work out where their stops are just based upon really, what the information is there. So essentially, then you can rinse those out, pick up the discount, and away you go again. But I think what a lot of people forget, and I've talked to a lot of people who have never been in silver before, and I say, do you know what? People forget that is actually money. It's actually a foreign exchange cross against the dollar, the yen, the euro, etc. It's amazing how few people, they think, it's just another commodity, isn't it? But it's not. And I think while spot silver isn't yet Basel III compliant, it is a deliverable FX cross against the dollar. So essentially, yes, you would have to, in the past, when we've tried to buy in the past, it would be that plus a premium. And then you'd be even restricted as to how much you could have. But I think that is starting to evaporate, because if I now am trading in a physical marketplace and I offer a price, who somebody who owns a physical bar is willing to sell that for, then we've got a real price. And I think so it's kind of that, in a sense, backwashes into the global fix for silver, which is the benchmark fix, where producers and refiners are locking that price in, or forcing hedging strategies upon your producers in a counterintuitive way. Essentially, I think the physical price is starting to evolve, and it's only just starting to evolve as this backwashes into huge, as you say, 100 to 1. I mean, Jeffrey Christian at one point said 500 to 1, and so what? So it's backwashing. And I think this is a really great time, as far as I'm concerned. Yes, I own silver, but I keep saying this is a great time to be looking at silver as an.
What used to be background noise is now the main event. A shift is underway, quiet, calculated, and years in the making. Physical gold is moving off the global chessboard and into vaults beyond the reach of Western oversight. Silver is telling a similar story. Inventories falling, premiums rising, and real metal quietly changing hands outside the old guard spotlight. Pricing power is leaking out of New York and London, and flowing toward markets that trade less in contracts and more in consequences. If metal ownership is consolidating into fewer, more determined hands, how long before the pricing model follows? And what happens to the players still clinging to paper illusions? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the daily updates. Thank you for the support, and I hope you enjoy the video.